Hey everyone, it's September 2nd, 2015. I'll keep it short for this week's video and review the S&P 500, the spot price of crude oil, with the use of symmetry to give us a better understanding on what markets may do over the near and far out future. Before I do so, let's take a quick look at our recent performance. Since the inception of the website on the 1st of June 2015, our stock-only trades have not made or lost subscribers money. In other words, if you were to invest money in every single trade we've recommended since the beginning of the service, you would have preserved your capital. Whereas if you would have invested your money in an index fund, a mutual fund, or an ETF over the same time period, you would have realized a loss of anywhere between 6 to 15% as of today. If you account for the option trades we've recommended for some of these stock trades, we're actually up 3.5%. When compared to a broader benchmark such as the S&P 500, stock-only trades are up or outperforming the index, 9%, and option trades are outperforming the index by roughly 13%. These are not mind-boggling numbers. They're not results I'm particularly proud of. Nevertheless, it's been a very hard market to navigate so far this year. And since many of our trades are swing trades, we rely on a dominant trend to be in place to really bear fruit. As you all know, the market, what characterized the market since the beginning of the year till today was the 60 to 100 point range in the S&P. That changed a couple of weeks ago when we got that notable price decline. And even so, even with the price decline, we still don't have a dominating trend, short-term trend in place. Of course, markets are cyclical. The current market tape or the beat will change, meaning that in the very near future, you're going to see a dominant trend established, be it up or down, and our trades should reflect better results as a result. So if you're somebody who has been interested in joining the service, now would be a good time. I'm extending the 7-day free week trial for any of those of you that are interested. Simply send me an email at smartstocks8@gmail.com, and I look forward to having you in the group and working alongside you. So let's talk about the S&P 500. On the monthly chart of the S&P 500, there are 2 points I wanna focus in on. First are these wide ranges that basically define the bull market of 1995 up to 2000, and the current bull market of 2009 up to this year's high. Both runs are fairly similar percentage-wise. The former was 241% or saw a 241% increase, while the latter saw a 260% increase. If we measure the price declines, now before I move on, the reason I bring this up is because I've read countless articles of people saying that stocks have hit their highs for good. This is the high everybody was looking for. Other people are saying this is a buying opportunity, and other people are just flat out confused. They don't know if to buy, to sell, or what to do. The one constant, the one thing I know for sure is that the high period of volatility we've experienced over the last couple of weeks has led people to be more confused than they were before, and in a way grow a certain level of animosity towards markets. Some people are resentful because the confusion drives in some way or some sort resentment, and this confusion is not really helping the case in establishing what most would like to see, in establishing a intermediate and short-term trend in the broader markets. The notable price breakdown is of major concern because it basically engulfed all of this year's move. The last time we saw a similar move was we saw it in 2011, which I spoke to some degree in last week's video. We saw it also in 2010. We saw it a few times between 2008 and 2009. And but the only other point in time where the current price breakdown is in any way similar, besides that of 2011, is the one we got in 1998 during the bull run. Now, I've made it clear that price symmetry is helpful in assessing broader market conditions, and by that I mean assessing key levels to watch for. Even if you're a day trader, you have to keep these levels in mind. Nevertheless, price symmetry shouldn't be the only tool, like any other tool, in assessing market conditions and really in assessing or producing an outcome on what markets may or may not do. It's just there, and it's a tool that's there to again aid your understanding of what markets may do. I always use it to assess. It's one of the very few first things I do when I evaluate the broader markets. Any good trader will tell you that the first thing they do when they evaluate any market is they observe what's going on before they slap on all these indicators, look at different sentiment readings, and do all this other stuff. First thing they do is they observe price and see how it responded, and then from there you can draw symmetry or parallels to see how if there's any coincidence whatsoever. Now the one caveat, and I've warned this many times before, is that if you're going to use price symmetry, you can't use it as you can use it as a blueprint, again, to see what key levels to watch for, but you can't treat it as an absolute, mainly because market cycles are constantly changing, and not any one price decline or price advance is the same in character or the same in composition. So to that end, here's the point I want to make. If there's anything or any similarity to the price decline we have had today is the one in 1998. If so, that would suggest a 60% move from current lows up to what would then be a high in the S&P. That would essentially put the S&P at 2,400. To be clear, I'm not insinuating or I'm not insinuating nor expecting the S&P to do that. Could it do that? Can it actually trade up to 2,400? I don't know, over the next 12 to 36 months? It could. But I'm just the point I'm trying to cover here is that through price symmetry, you can kind of get a broader understanding of what markets may not do. So if you were to use symmetry alone, it would suggest, assuming that we're in the same cycle in certain in the market, that the S&P is set to trade up as high as 2,400, or set up a similar pattern to what we saw take place between 1995 and 2000. That's one thing. The second thing, and the reason why symmetry is useful, is because look what happened here. Here I've highlighted an inverse head and shoulders formation in the S&P. Once the neckline was broken to the upside, the height of this range, of this formation, basically gave the high of the move, and eventually the 2007 high. So again, this shows you that price symmetry is relevant, but again, it's not the only tool that should be used when assessing markets. I know I've said this in just this week's video a million times, but it's amazing how people think because one thing may pinpoint the exact level on a particular move in any stock or index, that it's the tool to use every single time, and it's just not true. Now, as for what to expect, I've noted in last week's video that 1910 to 1920 is a higher weekly low in the S&P 500. That level has to hold on a closing basis, both on a weekly and monthly basis, for every single week and every single month from here until year end. Failure to do so increases, but does not confirm the probability of a move down to 1660 to 1680 on the index. We would have to break below 1820, or the 2014 October low, and below 1780 for there to be a confirmed move down to that price point. Otherwise, it's fairly reasonable to expect the index to trade in a wider range between 1910 to 2133. Of course, much, if not everything, will depend on how currency markets react to what the Fed does or does not do on their September 17th meeting. So I'll leave it to that. Here we see that the first fib extension is also pointing to an important point of relevance. This fib extension is not a support point, but it's a point of relevance or of note that should be taken into consideration. That's that. Now, for market bulls, for the short-term bias and momentum, not the trend, to change, we would have to reprice, or markets would have to reprice the S&P back above 196.48. However, it will take a move above 2014 and preferably 2045 to see this market trade back above the previous range. A move below 187 on notable volume, it has to be on bigger volume or as big volume as we saw last week, will undoubtedly push or test the resolve of this market and push us to at least down to at least 1780. And again, 1660 and 1680 will be the ideal target. Lastly, crude oil. The reason I'm mentioning is because everybody's focusing on crude oil. So what I've done here is drawn two inverted Fibonacci retracements, one from the 52-week high to the then 52-week low, and one from the current higher low to the lower high, right? And then another one, a third one, that pegs it from the current low up through the current higher lower high. So a few points of interest. The S&P, for oil to have any sort of possibility of gaining traction to the upside, it will have to do one of two things, or actually two things. First, it cannot overshoot to the upside. If it does that, it will most likely mean that what the move we got last week was more of an overreaction or a short covering phase, where shorts were basically trying to work off overbought or oversold, conditions in the broader markets for that eventual move lower. If so, that's one thing. It cannot overshoot, and price must consolidate in this lower price band between 1414 and 1490, or possibly as high as 1555. This higher low before there's any notable price appreciation. If those two conditions are met, then it's probable that we could see a move higher into year end and into 2016. So again, on the USO, 1414 and up through 1490, but as high as 1584 has to be the new range that needs to be considered, and for essentially crude oil or this ETF to trade in and out of for at least 2 to 4 weeks before there's any sort of an advance. So again, that's for last week's lows to hold any water whatsoever. And the very last point I want to draw to your attention is I've highlighted or I've included 3 different rectangles. What do these rectangles stand for? Well, when I was looking at the charts and comparing the recent decline in the price of crude oil to the decline we saw in financials back in 2008 through 2009, there was a few commonalities that I saw. Of course, they're not with their differences, but nevertheless, they're fairly similar. And again, here's where symmetry comes in handy. After we got the liquidation break in the price of crude oil, we got a sharp advance in price, followed by a retest of the lows, and then a distribution phase, which led to this second liquidation break, or break lower in price, however you want to refer to it. This is very similar to the move we got in the XLF, which is the financials ETF, back in 2008 to 2009. Of course, there's a few differences. Once we got a liquidation gain, we got the exact same price appreciation. But unlike oil, which then contested the lows, right, and then moved to the current high, it actually spent a considerable amount of time distributing right away before leading to the second break lower. Now, again, the two big differences is that we didn't see a move lower followed by move higher in a consolidation phase as we saw in the USO, and the price breakdown did not break below the 2008 low in the XLF, right? Those are two big distinctions to make note of, and that points to, again, both ETFs or both markets being in different market cycles on their own, and when taken into a broader perspective. But nevertheless, there is some symmetrical relation between both. So if we were to expect a similar move to shape out in commodities, once the low was established in the XLF, it took 821 days for a new high to be made. If we use the same method or apply the same method to the USO, that would imply that sometime towards the end of 2017, on December of 2017, January of 2018, we could expect these highs and possibly These highs depends, depending on again market conditions, to be tested. So in other words, $20 and as high as $25 in the USO could be in the cards by the end of 2017. In other words, in 2.25 years, to put it differently, that would put oil at roughly around $75 on WTI. So if you're somebody who again likes to relies heavily on price symmetry or takes it into consideration to some degree, these are the points. This is a an interesting observation that I came across. May not mean a lot, may not mean anything. In fact, we might see nothing alike shape out in oil, but it's something worth considering. So hopefully next week we'll get a better sense as to what markets may or may not do. Uh, if anything notable changes this week, I may do a second weekly video. If not, I'll talk to you next week. Blog post will be up again when as soon as I have some free time. I'll post more blog posts. I'll let you know in the description when I do. And other than that, I want to thank you for taking time to watch the video. Be careful. One point I want to stress is this market is waiting for you to make a mistake. It only takes on your part to make one mistake to put you in a hole that will take time, to dig yourself out of. So be careful. And if this is not your type of market, then you don't have to trade it. The market's not paying you to trade every day, and you just have to, you want to sit idle for a while until a clear trend is established. And by all means, do that. Could it mean you could miss out on the upside or to the downside of a few percentage points? Yeah, but if it's not your market, why trade it? What I see as most favorable right now uh, is the setup of pair trades. I think that should bear fruit given the high level volatility in the markets today. So it doesn't have to be a two-way pair trade. It could be a three or even a four-way pair trade, where you're essentially seeking that arbitrage opportunity in different markets and pricing in the anomalies to again to correct for themselves and hopefully make some money. So pair trades could be a safe way of trading this market without risking much, and again, not putting much capital at risk. Besides that, I want to thank you for taking time to watch the video. Be careful out there, and I'll talk to you next week.